Welcome to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, U.S. stocks pushing higher after CPI data coming mostly in line with estimates. We'll have full coverage ahead of the report and how trade talks will affect the data. Plus, shares of Swiss sneaker brand On rising as it lifts its sales and earnings forecasts. We'll sit down with the company's CEO to discuss. And Circle shares jumping after it posted a revenue beat in its first quarter as a public company. We'll dive deeper into those earnings with Jeremy Allaire. He's the Circle co-founder and CEO. That's coming up at 11:30 a.m. Eastern. You don't want to miss that. Let's get a check of the markets here now. We are seeing stocks rally across the board, although coming off the early highs of the session, even just 30 minutes in here. We've got the NASDAQ only up about 0.2%, as is the S&P 500. The Dow leading gains today up about 230 points here, about 0.5%. We have been seeing strength in the financials today, so that's one of the things helping bolster the major averages. And take a look at the bond market here, because we do have expectations pretty steady here for the Fed to cut interest rates. That is reflected in the interest rates futures markets, but not as much reflected in the bond market, where we're actually seeing yields go a little bit higher. That's after we got a year-over-year core consumer inflation rate of 3.1% last month. President Trump saying on Truth Social that he is considering a, quote, major lawsuit against Federal Reserve Chair Jerome Powell over ongoing $2.5 billion renovations to the Fed's headquarters. Powell has previously defended those renovations, which were approved by board members back in 2017. Trump visited the Fed's headquarters to tour the renovation progress back in late July. Henrietta Trace, Veda Partners managing partner and director of economic policy, is joining us now. Henrietta, it's good to see you. We were expecting right on cue, right, the president's commentary following the consumer price index data this morning. It seemed like things had sort of died down about the renovations. How it's always tough to know how seriously to take the president about stuff like this. So how do you weigh his comments this morning?
Thanks for having me. I really like to take the issues that the president takes seriously, just as seriously as he is. And I think what this morning's tweet suggests is that he knows he's living on borrowed time with the inflation that will come from his tariffs. So let's throw out some numbers to put some data around it. The base case tariff that the U.S. consumer is eating right now is 8%. That will rise to 16% in the weeks and months ahead, now that 5 days ago, he escalated tariffs across the entire globe and whole categories of imports. Goldman Sachs estimates that ultimately the U.S. consumer will eat 67% of the tariff rate. There are tariffs on at 15, 20, 25, 40, 50%. And those are going to continue to seep into the system. And so President Trump's sense of urgency, as illustrated by his Truth Social post, is that there's a clear understanding that the Federal Reserve is got a real problem with increasing unemployment, as evidenced by the last couple months worth of data, and rising inflation, which will only get worse. So he has to act to pressure Powell now, urgently, which is what he's signaling, because the economic picture is deteriorating because of his policies.
Well, it's interesting, Henrietta, because the market doesn't necessarily agree with you. The market seems to think that this data is in line enough to allow the Federal Reserve to cut in September. It's interesting that you're saying this. A colleague just forwarded me a note from Neil Dutta, the economist, who said he thinks the market reaction to today's data is surprising as well, because he sees it as indicating symbols of signs of inflation here. Where do you think the disconnect is here?
Well, I think there's a lot of factors here. Number one, the market is really excited about a Fed rate cut. So that is always going to drive the core narrative and always be, the last topic of conversation in any meeting that you have. When are we going to get cuts and how many? So to the extent that this looks like we might get more cuts because the unemployment rate, as I mentioned before, is ticking up, that is very good news for those looking for inflation rate cuts. That is precisely the opposite argument that the president is making, of course, which is that the economy is strong and the Fed should cut rates. The market is telling you the opposite, and they're optimistic about a rate cut because now unemployment can be the main gauge that the Fed looks to instead of inflation, since it came in line with expectations. And then let's also be mindful that this is an expectations game. So we expected inflation to rise. It continued to rise. It wasn't worse than expected. So that's what the market is digesting. And they're seeing a deteriorating economic employment picture, which allows them to get more optimistic about a rate cut in September.
Henrietta, we were discussing with Jennifer Schomburger, our Fed reporter, a little bit earlier now, the importance that the next labor report will have in early September, looking back at August, but also the difficulty in reading that report because we have seen such big revisions. So how are you thinking about that report? How should investors be thinking about that report at this point?
I think we should expect the same number of revisions to be required in this next report. There's no reason to think that there has been more money poured into the BLS, or that there has been a modernization update since the last month's worth of data. So there will continue to be these revisions. It's important to know that the current commissioner, who is the acting commissioner, has already held that job twice before. So there's going to be some continuity of governance through the period of time when the Senate can nominate and confirm the president's nominee, who, by the way, is being pretty roundly rejected by the economist universe from all kinds of major institutions, from former commissioners who held that role to current professors of economic policy and other folks who travel in these circles universally from both sides of the aisle, conservatives and Democrats. So I think there's going to be concern, but we can probably push that out until November, when I think the senators will ultimately get around to confirming Bureau of Labor and Statistics nominee.
Right, and that is E.J. Antoni. And to your point, we talked to the economist Claudia Sahm earlier about his qualifications, and I want to play for you what she had to say.
My biggest concern is the BLS is facing a lot of challenges. It is legitimately hard to run surveys, construct statistics, communicate them to the public, get them out in a timely manner. And frankly, this nominee just doesn't have a lot of experience and background in measurement and statistics.
Now, all of that said, and the concerns that you talked about as well, that economists pretty broadly have about this pick, all of that said, Congress has been pretty rubber stampy when it comes to President Trump's nominees, really across the board. Do you think, though, that things have changed enough that there would be real opposition to this pick?
I don't think so. I'd be pretty surprised if there were. There are 4 senators you want to watch, and this is really the core of my job, is to watch the senators and understand which ones are willing to step out the bounds for which issues. There are 4 that I would highlight. The 2 from Kentucky, Rand Paul and Mitch McConnell, both of whom have, especially McConnell, has been very willing to confirm the president's cabinets and nominees, believing that he has the ability and the authority to pick his own cabinets and commissioners, which of course he does. And then there are 2 additional members, Susan Collins and Lisa Murkowski, but I wouldn't expect a lot of blowback from them. So as of right now, I'm not seeing enough of a dull roar to move into a place where he may not be confirmed. I think there'll be bigger problems at the Fed chair.
Gotcha. Well, we'll leave that for another day, since that's the next horse race that we'll be talking about. But Henrietta, while I have you, I do want to get your take on the latest China headlines. As expected, the president has now pushed back the deadline to November 10th for the negotiations between the U.S. and China to continue. How do we think they're going?
I think the delay had to happen. Let's think about where we are right now. U.S. agriculture purchases are cut in half, more than half, down from $11.6 billion in the back half of 2024 to less than $5.5 billion in the last 6 months. U.S. farmers are getting smoked. Why? Because they're the first line of defense in any trade war, especially with China, who buys so much of our soy. And China has now expanded and changed its laws internally to allow more purchases from Argentina, which is going to permanently cut U.S. farmers out of business of China. So the narrative, the conversation, the negotiations with China are actually looking a lot like the phase 1 agreement we got in Trump's first term, which is that they're steering towards agriculture, which is an easier lift for both sides to agree on, and moving away from the really sticky stuff like forced tech transfer, human rights violations, and all the other components that allow for the president to do things like just charge 15% more for the export of what used to be a national security threat level export restriction on NVIDIA chips or AMD chips, for example. So we're steering into the easier off-ramp, which is agriculture purchases. That creates the opportunity to keep tariff rates where they are and avoid the escalation to 80% that obviously would have upset the inflation numbers going into today's data.
Henrietta, what kind of signal is China sending with these reports that it is telling firms within China not to buy NVIDIA's H20 chips?
I think that it means they know that there are alternative routes they can pursue. They'd rather promote domestic industry and get their relationships with other nations like South Korea, Japan, expanded and rely on non-US partners for trade. And you can see that with the EU as well. So that's really fascinating to watch. The ripple effect of the president's trade war with China is that it's drawing other nations closer to China, which of course is the exact opposite of what you would have hoped.
And Henrietta, finally, what you were talking about in terms of the more difficult parts of the deal to do you expect then sort of phases of the deal to be announced? For example, first, here's an agricultural agreement we've come to. Then maybe there are other parts and phases of the deal. Is that how it could play out?
Julie, this is an excellent question. That's exactly what the administration is going to have to do. And one of the things that I really like to focus on, or I think is critical for the markets, is that there's this opinion that tariffs are one and done. Never mind that we've already gotten a dozen in tariff rate hikes in the last 6 months, and there are many more to come across 9 different sectors and across different nations with secondary tariffs and all that thrown in. But each additional phase, there will be 3 with India. There will be however many with China. We don't have the first one done with the EU, for example. Every single subsequent phase is more complex. As you move away from just buying soybeans or beef or genetically modified corn, that in itself is a huge issue for India, for the EU. But imagine as we get into things like how we're going to tariff pharmaceuticals or forced tech transfer, as I mentioned before, human rights violations with nations from Nicaragua to Vietnam, transshipping, actually defining what those components are. Every phase of this negotiation gets more difficult, and there will be many phases. They will take the next 3.5 years.
Henrietta, great to talk to you as always. Thanks so much. Appreciate it.
Thanks for having me.
Coming up, Stablecoin Explainer, and we've got much more markets action as well. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke Tamama. We're live at the NASDAQ. Let's get a quick check on the latest market action. We're about 1 hour into today's trading session, and all 3 major indices are looking to hit record highs. Taking a closer look at the YF Interactive, we're seeing a bit of headlines come out this morning that's leading this market up higher in the early hours here. We heard from the CPI report that largely came in line with expectations, and that led to a hot start this morning as all 3 major indices are now in the green. We are seeing the NASDAQ up the least amount, a bit of a change there from what we've seen in recent weeks, up about 0.4%. The S&P 500 also looking for record highs as we're getting more calls on the street that we could see the S&P 500 move towards 6,600 in by year end and into 2026. And then the Dow really leading the momentum here, up about 1% and up more than 400 points in the earlier hours of trading here after, once again, that CPI report came in largely as expected. We all are also getting some posts on Truth Social from President Trump. Once again, President Trump calling Fed Chair Jerome too late Powell, saying that he must lower the rates now. But if you take a look at this market, investors are pleased with where we're at now, as there's a higher chance that those Fed rate cuts will happen in September. Investors now pricing that in. Based upon the FedWatch tool, that's a 94% chance of those Fed cuts happening in September, and markets certainly pricing that in. We're seeing most of the action here in the green, as you can see here on my screen. On holding, actually leading the momentum here in the NASDAQ 100. That stock up more than 7%. We'll speak to the CEO shortly. Right behind that, we have Microchip, among a few others. And if you take a look at the Dow, also seeing lots of green across the board this morning. United Healthcare, Goldman Sachs, Bank of America leading the way there. Also Home Depot up about 2%. We'll be hearing next week from them as far as their earnings report. Nike maybe getting a bit of a bump off of On, up about 2% as well. But once again, all 3 major indices looking to understand and make conclusions about what exactly this latest CPI report means for the Federal Reserve come September, and also trying to navigate those latest trade headlines with that 90-day extension between the U.S. and China. But keep it right here on Yahoo Finance. We'll be tracking all these market moves and latest announcements throughout today's trading session.
Now it is time for some of today's trending tickers. We are watching Apple, AST, SpaceMobile, and Celanese. First up, watching Apple as Elon Musk threatens legal action against the company. The Tesla CEO posting on X accusing the company of antitrust violations, saying Apple makes it impossible for AI companies that aren't OpenAI to make it to the top of the App Store. In his post on X, Musk asked if Apple is, quote, playing politics by not highlighting his products. Apple and OpenAI have a partnership around AI built into the latest phones. Musk also has a long-running feud with OpenAI CEO Sam Altman. The Tesla CEO says XAI will take immediate legal action. Next up, AST SpaceMobile rising after the satellite company set out an ambitious plan to launch 45 to 60 satellites through this year into 2026. The company also said it received 2 additional early-stage contracts from the U.S. government. Analysts at Cantor Fitzgerald seeing positive catalysts across liquidity, spectrum, and government opportunities. Scotiabank, though, cautious over the company's monetization model and global spectrum ambitions. And finally, chemical manufacturer Celanese sinking today after providing a disappointing third-quarter profit forecast. Management expects softening demand across most key end markets in the second half of the year. The company sees its price target. UBS is cutting its price target as a result to $49 from $66. In the earnings release, CEO Scott Richardson said the company will continue to emphasize cash flow. And as always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Stablecoin issuer Circle reporting its first earnings report since its blockbuster IPO, topping analyst estimates for revenue in its second quarter. Meanwhile, the company swung to a net loss of $482 million. That was due to charges incurred during the IPO process. The company also said it saw 86% growth in the circulation of its stablecoin USDC in the second quarter. What exactly is a stablecoin? Yahoo Finance senior reporter Ali Canal breaks it down.
Let's talk stablecoins, a fast-growing part of crypto that's catching the eye of regulators and investors. Most stablecoins are pegged one-to-one with the US dollar, so think of them as a digital version of cash living on the blockchain. Unlike Bitcoin, which can swing wildly in price, stablecoins are built to do one thing: stay stable. That stability makes them useful not just for crypto traders, but also for everyday things like payments, sending money across borders, and even saving. Central banks and fintech firms are testing stablecoins as the backbone of the new era for faster, more efficient global payments. But there are risks. Their reliability depends on what's backing them, usually cash or US treasuries, and how trustworthy the companies issuing them actually are. Big names like Circle, PayPal, and Tether are already in the game, issuing their own stablecoins. And as this space grows, stablecoins could become a cornerstone of digital money, as long as trust, transparency, and regulation can keep up.
We're going to dive deeper into Circle's earnings with Jeremy Allaire, Circle co-founder and CEO. That's coming up in the next hour. You don't want to miss that. Got much more markets action coming up. Stay tuned. You're watching Market Catalysts. Swiss sneaker maker On soaring after raising its full-year guidance. This after the company reported 32% sales growth in the second quarter, boosted by strong demand. Joining me now, Martin Hoffman, On running CEO and CFO. Martin, it's great to see you. So talk to us about the demand picture here. I know you guys also are getting an increasing amount of your sales from direct to consumer. So how are you getting to them? How are you communicating with them? And what's behind the demand?
Thanks for having me. On has a very strong momentum across the world. We are growing very strongly in all regions, in all channels. And I think, as you said, this is most visible in our growth of our D2C channel, which has seen 55% growth in the quarter. And that really shows the momentum that we have from the product launches that we did recently. We are building more and more franchises, which means we put more resilience into our brand. Apparel is growing very strongly and becomes a much bigger part of our business. And there's so much energy all around the world. And it's actually rather accelerating than slowing down.
And Martin, perhaps even more than the revenue gains that you guys saw, your profit margins, I think, are a focus for the street and for investors. Gross profit margin last quarter, 61.5%, and you all have a longer-term target to keep it at 60%. and above. In an environment where costs are rising, both in and of themselves, but also because of tariffs, how do you get to that margin?
I think this is where the power of On being a premium brand is most visible. This really allows us to drive a premium customer experience, to grow our D2C channel, to have more meaningful connections with our customers. But then also the innovation that we have in our products allows us to launch products at higher price points, and that is driving a superior margin profile. And we have done a lot of work in the company to set ourselves up for that margin expansion. And it's also helping us in an environment like now where we see disruption on our cost of goods sold. And I think that the strength of what we have building is showing up in our financials. This is why we increased not only the top line to 31% full year growth, but also increased our gross profit margin, increased our EBITDA margin, and it's reflective of that strength.
Martin, I want to bring in our Brooke DePalma, who covers consumer companies like yours. Brooke, you, like me, you've been watching this sort of margins question very carefully.
Yeah, absolutely. And what we've seen over these past few months is On Running be able to navigate this environment with tariffs. I know that you guys announced a price increase back in July that took effect. Is there plans to do more going into the second half of the year? And if so, do you think that you have the ability to do it based upon this perception of consumers?
I think it's important to go a step back here. So first, for us, it's super important that we have now clarity with the executive order that we can plan with. Our industry has always been exposed to tariffs in the US. This is nothing new for us. Ever since On exists, we have been paying around 20% of most of our imports. And now this number goes up to 40% for importations from Vietnam and 39% for Indonesia. So of course, it's something that we don't like, but we are a premium brand. We are a fast-growing brand. And with that, we have so many opportunities to mitigate that impact that this allows us to increase our margin outlook. It allows us to be very confident that also in the long term, that 60% plus gross profit margin that we laid out 2 years ago is still what we believe in and what we believe we can achieve. And so it becomes part of our business now, having those tariffs. And I think in times like this, it's super important to focus on what you stand for. And we are a premium brand, and we want to be the most premium global sportswear brand. We keep on investing in quality, in our innovation, in our customer experiences, in sustainability, in social impact. Those are non-negotiables. And besides that, we have not yet spoken to our factories. We have not yet spoken to retailers because we didn't need to. And the same is for price increases. We don't need additional price increases this year to mitigate the impact. We have done the increase in July, but there's so much momentum across basically cost of goods sold.
Martin, Julie again, have you gotten so those price increases that you instituted, you're not going to do any more price increase, you're not planning any more price increases this year. What has been the reception of retailers and customers to those price increases? Have you seen any kind of shift in what they're buying, in terms of cost sensitivity at all?
Obviously, it's early, just after 5 weeks, but July was actually the strongest month in the history of the company. So from that perspective, we don't see much. We also see that our order book remained very stable, and customer and our retail partners haven't changed that. And again, for us, the pricing is based on our premium position. It's rationalized because of the innovation and the products that we bring to the market, but it's also a strategic position where we want to be. We want to be perceived as the most premium brand, and pricing is part of that. It's not the result of the tariffs.
Martin, you said on the call that the sell into wholesale partners were at a lower level because of the timing of product launches. Walk me through how exactly that looks heading into this key holiday and back to school season. And also, as your competitor, Nike, is looking to get back in the wholesale game as well.
Yeah, we always have certainly seasonality when it comes to selling in new products into our wholesale partners, which has a lot to do with launch cadence. It's not about the fundamental growth of the company. If we look at I think the D2C number that we spoke about, this reflects the momentum that we have as the brand. And this is also what we're seeing in the sellout numbers of our partners. And with that, we have a lot of confidence for the rest of the year. We focus on ourselves, on the innovation that we bring. The brand has incredible momentum. Look at Asia, for example, where we, for the third time in a row, we more than doubled our business. I've just been to most markets there. It's amazing to see the passion for the brand and the energy also within our team. And that's what we are focusing on. And there's more product coming. We are getting, again, more wider spread from running to tennis to outdoor to lifestyle. We are building more meaningful franchises. And that makes us really resilient in the future and for the future.
Well, certainly looking out for those light spray shoes as you ramp up the production there. I did quickly want to ask, you mentioned something really interesting in the call about the Gen Z consumer. You said that On actually over-indexes to Gen Z. I've heard from so many of my sources that group of individuals is under pressure. How are you offsetting that? How are you over-indexing into Gen Z right now?
Yeah, so it's a segment that for us was rather underrepresented in the past. We have initially grown with the consumer group more 35 and older. And in the last 2 years, we have grown very much strongly with that consumer group, also with the help of partnerships with Zendaya and FKA Twigs. What we're seeing from that consumer group, it has a lot of purchasing power. If we look at customer lifetime value, have retention rates at basket sizes is very comparable to also the older customer. So for us, it's a super relevant consumer group to add. At the moment, we are stronger on the female side. We still have work, but also a lot of opportunity on that younger male side. And this is something that is very much on our list for the future.
Martin, thank you so much for joining us. It's great to see you. And thanks to Brooke as well. I really appreciate it.
Thank you.
Take care. We got much more markets action coming up. Stay tuned. You're watching Market Catalysts. July's consumer price index coming in mostly in line with estimates, up 0.2% month over month and 2.7% year over year. Meanwhile, core CPI, that excludes volatile food and energy prices, it rose 0.3% month over month and 3.1% year over year. That was slightly above estimates. Yahoo Finance senior reporter Ali Canal's got a closer look at CPI data and why it matters.
The Consumer Price Index, or CPI, comes with two key numbers, headline CPI and core CPI. CPI measures how much prices are changing each month for a basket of goods and services we all pay for. That's everything from eggs and milk to cars, medical care, and even sporting goods. Headline CPI is the overall inflation rate for that full basket, whereas core CPI is that same measure, but it strips out food and energy. Those are two categories most prone to big and unpredictable swings. So why remove them at all? Well, things like weather and geopolitics can send those prices soaring or falling in a way that can distort the broader trend. A drought can push food prices higher. A conflict in a major oil-producing region can disrupt supply and send gas prices spiking. That's why the Federal Reserve often puts more weight on the core reading. It gives a clearer picture of underlying price pressures. The same idea applies to another key inflation gauge, the Personal Consumption Expenditures Price Index, or PCE. That tracks what consumers are actually spending. It's the Fed's preferred measure when setting monetary policy, and just like CPI, it comes in both headline and core versions. The core PCE removes those volatile food and energy prices so policymakers can get a better read on long-term inflation trends.
U.S. small business sentiment hit a 5-month high in July. It was the highest level since President Trump's tariffs took effect, as owners became more optimistic about the U.S. economy. Here to discuss is Elizabeth Gore, co-founder and president of Hello Alice and host of the Yahoo Finance podcast, The Big Idea. Good to see you.
Howdy.
So where is this confidence coming from?
You know, well, one is the time of year. Back to school is a big time for receipts for small business owners, but also things are settling down. There's less confusion about the tax bill, less confusion about where tariffs going. So optimism means there's going to be a higher spend on software, and we're going to see more folks hiring for their small business.
Okay, so that's the good part of it, right? But the reading was just slightly above the 52-year average. So we're still around average sentiment. I guess I'll take the other side of it now. What are the things still weighing on sentiment?
They're waiting. You know, there's a federal course right now, case that 5 small business owners sued around tariffs. So I think there's a lot of eyes on how tariffs really are going to impact small business in the long term. We're also waiting for deregulation that's been promised. And then capital's still quite expensive. So we're still kind of waiting for capital to catch up with this excitement.
And so the folks that you're talking to, how are they sort of processing with and dealing with all of this in real time?
You know, post-COVID entrepreneurs, they can iterate faster now. They know problems are going to come that are unexpected. And so they also are smarter about keeping more capital in the bank. And so they keep, you know, used to be it was about 4 weeks. Now we're seeing 2 to 3 months in the bank. So if there are tariffs that come through or a natural disaster or something that happens, they're not as frightened about it and they're prepared.
I'm also curious about the rate cut outlook, right? Because the cost of capital for small businesses has been at a higher level for a while. So I imagine they're looking, I mean, are they also waiting for that potentially?
Absolutely. So what you're going to find is larger capital purchases, they're still going to wait. So if I need that new oven, if I need that new truck, anything that's going to have a little bit higher credit or loan, we're still going to see that waiting. However, they're going to spend incrementally more in a small way on things like software, on efficiencies, any kind of payable receivables, anything that can help them with their efficiencies, you are going to see a higher spend on that.
And, you know, if we are seeing improving sentiment on Main Street, what's the kind of ripple effect of that?
Well, you know, if I'm the Fortune 1000 and I'm selling into small business, so let's think PayPal, Intuit, Square, Dell Technologies, they are actually, this is a good time to really sell into small business. So anything that's supporting the small business market, I think you're going to see an uptick in their stocks and also their sales.
Gotcha. And then I'm also curious how the folks you're talking to are incorporating AI.
Oh my goodness. Well,
you were talking about efficiencies a minute ago,
absolutely.
right?
I'm really excited because we went from a 7% adoption of AI on Main Street to almost a 26%. Might seem low to the corporate folks, but for small business, that's extreme. You know, the Inc. 5000 list is coming out this week, and we're excited on the big idea to release it Thursday. And for the first time ever, there is an actually AI sector of the fastest growing businesses for small and medium businesses. However, if you look at large percentage growth like construction, government services, those are all now AI-enabled businesses. So even Main Street is adopting AI through and through, and those are the fastest growing, even in categories you wouldn't think are actually using it.
Huh, that's pretty cool. All right, and that's a good tease for the podcast. So we look forward to that release.
Can't wait.
All right, thanks a lot. And be sure to check out the Big Idea podcast with Elizabeth Gore. It's every Thursday for more on the world of small business. Coming up, we got much more markets action. You're watching Market Catalysts. Movie theater chain AMC topped Wall Street's estimates in its second quarter, with revenue rising over 35% and losses narrowing to $4.7 million compared with a $33 million loss a year earlier. Growth in the quarter driven by a 26% rise in theater attendance as big blockbusters were released in theaters. If you look at the shares and how they're going today, they're up about 2.5%. They initially actually jumped after results were released on Monday morning, and they're extending those gains. So we want to get an analyst take on the stock from the lone AMC bull actually on Wall Street. Alicia Reese is joining us, Wedbush Securities Vice President of Equity Research. Alicia, thanks for being here. So as we look at these AMC numbers, which look impressive, as I mentioned, part of what drove them were just movies that people wanted to see in the theaters. Right. So I'm curious in terms of what AMC, there's obviously a lot AMC can't control. They don't make the movies. But in terms of what they can control, what did they do well? How did they execute well this quarter?
So the reason for our recent upgrade has largely to do with our bullish view on IMAX. AMC has the largest IMAX footprint in North America, and they're leaning in. They're doubling down on not just IMAX, but their other large screens as well. And people are going to those large screens. And I think the content that we have in 2025, especially in Q4, and then throughout 2026, positions AMC to gain more market share and to print some really fundamentally positive numbers, particularly all of their per caps. So as the people who tend to go to those large screen premium IMAX viewings also spend a little bit more on concessions. And AMC is also doing really well with their loyalty programs. And so again, more per caps, higher revenue per attendee, and they're doing really well with that. And so that there's some really nice leverage on that, and they can get back to historic EBITDA levels and EBITDA margins without getting that same level of attendance that we saw pre-pandemic, which was really peak for the movie industry.
Interesting. So in other words, if I'm going to get off my couch to go see a movie, A, I have to want to go see the movie, but B, it has to be more of that bigger experience, right? The screen is big. I'm buying some stuff to eat while I'm there. It's, you know, it's more of a day or a night out, I assume. And, you know, how much more does AMC have room to lean into that kind of experience, you know, in terms of the percentage of its theaters who offer that kind of bigness of the night out?
Yeah, well, so they have quite a few already, and they can lean in and add more IMAX screens, which they plan to do, but a lot of them are upgrades of screens that they already have. And it's interesting because what you'd think is that AMC is really raising price and that they're trying to, you know, raise price on concessions, and that's not really what they're doing. They're offering higher priced options for people to opt for, and people are opting for those. They're offering more merchandise like the popcorn buckets and other things, other items, and people are opting for those. And people are opting for those larger screen tickets, so they don't necessarily have to raise price. They're also offering cheaper ticket days like the discount Wednesdays and Tuesdays, and allowing people who are more price sensitive to still go to the movies, and that should draw more attendance and more concessions purchases, which we all know are a significantly higher margin, and that all leads to EBITDA expansion ultimately for AMC.
You mentioned a moment ago that movie attendance was peak pre-pandemic. Will we ever get back to those kinds of numbers?
I don't think we'll get back to those attendance levels necessarily. We could. It's certainly possible. But that was like peak Marvel, Infinity War and Endgame, and so much volume of content. Now, the studios were very, relatively healthy back then. And there's a lot of competition right now. And a lot of the theaters are putting more and more to their streaming services. What they've realized since then, though, is that can all coexist. So there's not so much, drama anymore about what they put on their streaming services, because by and large, if they put it on the screen, it shows really well on their streaming service as well. There's a real good, coexistence there, and good marketing as a marketing tool, if nothing else. I do think there's, a significant case for attendance rising to a normalized level close to that, but the EBITDA should surpass that, because you just get better leverage on it and you get better per caps.
And Alicia, finally, I got to ask you, we've gone through this whole interview talking about the fundamentals of this company. We haven't talked about the sort of meme-ness that the stock has historically had. Has it moved past that? Is it less relevant now? How do you think about that?
Yeah, so it certainly was tough to invest as an institutional investor. As a retail investor, it was surely a fun ride. The share issuances and dilution, over time have chased away a lot of retail investors. There's still many in the stock. I'd say right now it's finally fundamentally sound. The share price, which it's trading, is reasonable for institutional investors to get back in. The concern is, are they going to issue more shares? And there is, more share issuance already planned around the December shareholder meeting. It's an exchange for some debt, and AMC still has significant debt that it needs to work through. It already worked through all of the debt that it had to repay through 2026, so there's nothing imminent. But, if the box office goes through any sort of slump, they may have to resort to that. So that's really the question here. We need to work through that. I think they have a lot less to do now in terms of dilution. They could do it with just money they earn from their theaters. And so that really took away a lot of the overhang for us.
Gotcha. Alicia, thanks so much for your perspective.
Thanks.
It's helpful. Thank you. Coming up in the next hour, we'll be hearing from the CEOs of Circle and Dutch Bros. Don't go anywhere. Coming up this hour on Market Catalyst. First up, U.S. stocks trading higher after the July Consumer Price Index report. Can the rally continue? We'll discuss with one Wall Street strategist who just boosted his S&P 500 target. Plus, we'll sit down with the CEO of Dutch Bros to talk to the state of the business as tariff threats loom over the company and the industry. And Circle shares jumping after posting a revenue beat in its first quarter as a public company. We'll dive deeper into Circle's earnings with Jeremy Allaire, Circle co-founder and CEO. You don't want to miss that. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets here. Taking a look at the major averages, we are seeing a rally underway here. Actually, stocks rising to the highs of the session right now. The Dow up almost 450 points, 1%. The S&P 500 rising about 2/3%, just over 6,400, and the Nasdaq rising by 2/3% as well today. And optimism in the market has fueled several S&P 500 price target raises, the latest of which came from Citi, the firm lifting its year-end target for the benchmark index to 6,600 from 6,300, citing benefits from the One Big Beautiful Bill, strong second quarter earnings, and tariff headwinds that have mostly been modeled in or priced in by now. Joining me now, the man behind that call, Scott Kronert, Citi Head of U.S. Equity Strategy. Scott, it's great to see you.
Good morning, Julie. Great to be here.
So it seems like a lot of the reason behind your call had to do with earnings, and this earnings season coming in better than estimated. Why do you think it did? Why do you think these companies have been able to beat? I mean, companies always beat, to be clear, but the rate at which they have been beating and what they have been saying in their reports has definitely surprised the street. Where do you think that surprise comes from?
Yeah, so I think there's several things at work. The first is, and most important, is that there's just underlying positive inertia that we've been navigating for the better part of the past year or two. But against that, we've had this tariff backdrop that's been in place since the spring. There, the news is a little bit less bad than feared. And so less bad than feared can also be good in terms of where you're going with your earnings expectations. Further, you're seeing companies respond to a lot of the tariff issue with their own internal work in terms of productivity improvements, cost cutting, and so forth. So they're mitigating this and making themselves more efficient. And then lastly, I think what we're looking at going forward is some benefit of a weaker dollar, which has been a tailwind for revenues for many global or international companies. And still ahead of us, we think, is probably some ongoing positive impact of some of the tax reforms that came with the latest budget bill. So all told, it's a pretty constructive S&P 500 earnings picture right now.
Scott, when you look at all of this through the prism of the CPI data that we got today, it's quite interesting because I was reading some economist commentary this morning, which said, you know, if you look at the data today, it looks like that firms are not passing on all of the tariff increases to consumers. So you would think that they would be then taking a hit to profit margins. But it sounds like what you're saying is they're cutting elsewhere in order to not take that hit. Is that the right way to be thinking about it?
That's the way we're thinking about it. Now, of course, it's going to vary from company to company, but I think you're spot on. For the better part of a year now, as we've been talking about Trump policy effects and the potential risk with tariffs, our view is that it's probably more of a gross margin issue than it is an inflation issue. Why is that? It's pretty simple. Our view on the U.S. consumer is that it's been gradually getting a little bit more difficult for the consumer, such that we think the willingness or ability to accept price hikes in response to tariffs probably lesser than has been perceived perhaps by many economists. So the point here is that companies aren't sitting still. They're looking to navigate a lot of these issues, whether it's how they think about their supply chain and how they think about other cost initiatives, et cetera. So the point here is that, yeah, these tariffs are an issue, but there is an element now where we do have some income to the federal government coffers coming from tariffs. But at a company-specific level, we're finding that the issues to a certain degree are being mitigated versus what we had been talking about earlier in the spring.
All of this said, when you look at what has propelled the market higher, particularly since the lows, there are really only two groups that have outperformed the S&P 500 since the April lows. One of them is tech, and the other one is industrials. And so if you look at tech in particular, there's been so much discussion and hand-wringing over the concentration risk in this market. But is it a risk? Does it matter if tech has accounted for the bulk of the gains?
You know, Julie, it's a really good question. And the important observation there, and this is some work we did a couple of weeks back, is that when you look at, let's call it tech, but let's say the AI play and where there's an AI connotation to company fundamentals, our work suggests that literally half of the S&P 500's market cap is attached to this AI surge and this spending surge. Industrials, to your point, are benefiting from that as part of the build out of, let's call it that, data center infrastructure, if you will. And at the same time, the industrials are catching a tailwind from a lot of the defense spending initiatives that are now following into place and augmented with what we're seeing over in Europe. So the point here is that you're seeing this broader AI influence really permeate the index at a bigger level than just tech. But here's where it gets interesting. We like to look at PE to growth or PEG ratio as an indicator of what's being priced in. And it's quite interesting that this tech industrials AI part of the market is actually less expensive relative to its growth than our other parts of the market. So our view is this can persist, okay, so long as you're seeing this ongoing spending inertia and tailwind and seeing it translate into fundamentals, which again is what we're seeing, I think, in the earnings reports with Q2, and we think will persist for Q3 and 4 for sure.
So this is really interesting. So even the industrial trade is the tech trade effectively. And to go back to my question then, I guess, is the AI trade and its universe large enough to lift the whole U.S. economy for an extended period of time, and therefore also the markets for an extended period of time? I mean, I guess it already has.
Well, yeah. So let's talk about what extended period of time. So, we like to think increasingly in structural terms and then versus cyclical terms. So cyclical, yeah, that's where we're contending with the CPI data today, with Fed action, traditional, macro matters that influence the fundamental condition. But when you look structurally at what's going on right now, yeah, let's call it this AI infrastructure spending tailwind that's going to affect positively those companies directly exposed. Longer term, the structural opportunity here is going to be more for the companies that are beginning to utilize AI techniques and processes into their own businesses in a way that ultimately leads to better productivity, higher margins, potentially higher profitability. And what comes with all that is a higher valuation and less volatile earnings over time. So the structural setup is, hey, we're still probably early innings in terms of the AI infrastructure build out. The bigger, longer term play is going to be more companies incorporating AI to better, get their own company production and profitability metrics, sort of in their own strategic up and to the right pattern.
So all of what we've been talking about so far sounds pretty darn bullish. What is the biggest risk to that 6,600 target before the end of the year?
Okay, so two things. So first is, let's just be real about this. We're looking at an extended sentiment backdrop. Our Lefkovich index is in euphoria. Historically, when you're in euphoria, volatility tends to become a little bit bigger deal short term. So we're on the lookout for volatility episodes. We want to be prepared to buy into those periods of weakness. But the other element, Julie, is that what really goes on here is that this AI construct is a pretty big deal, right? And we saw what happened earlier in the year when DeepSeek came into the picture, disrupted it, and suddenly what you thought was early innings in terms of an AI build out was mid to late innings. So what we're really concerned with here is another incremental shock effect that could come in. And by virtue of being shock effect means you can't really anticipate it. You can't see where it's going to come from. But I'm probably more concerned about anything that would disrupt this AI tailwind, if you will, much more so than I'm looking at from a traditional macro lens, where there I think the landscape is in pretty good shape, particularly as we go into the fall months and get some Fed ease behind us as well.
Really interesting conversation, Scott. Really appreciate your time today. Thanks.
As always. Thanks, Julie.
We got much more markets action coming up. You're watching Market Catalysts. Dutch Bros is getting quite the buzz on Wall Street. The rising coffee chain stock is up nearly 30% year to date as it navigates tariffs and expansion plans. Brooke DePalma here with CEO Christine Barone. Brooke, take it away.
Good morning, Julie. Good morning, Christine, as well. Christine, I want to start with those tariffs. We know that 50% of Dutch Bros coffees is sourced from Brazil. That's gotten lots of attention. In today's CPI report, coffee is up more than 14% year over year. How are you navigating this right now?
Good morning, Brooke. Thanks for the question. So as we look at tariffs, we have our coffee prices locked in for the year. We have a tariff on all of our countries, including Brazil, and that's something we've priced in. Our teams have done a really nice job of looking for other areas where we can save. They were able to find some dairy savings, so we feel really good about how we're positioned for the year, heading into a difficult year for coffee prices, but something that we believe we're well positioned to navigate through.
Christine, will you eventually have to pass along higher prices to consumers come next year once that contract ends?
So, Brooke, the way that we think about pricing is we really look at where our customers are in each and every market. We do a lot of pricing work to understand by platform kind of where we are versus others in the market. We feel really good about our pricing. We feel really good about our team's ability to navigate whatever comes, and our ability to really keep our prices in a place with an excellent customer value proposition, which is where we are today.
Expansion is one of the key things that every analyst that I speak to are most excited about when it comes to Dutch Bros. You have that long-term goal of 7,000. Is there any timeline that you can hold investors to?
Yeah, so as we look at our timeline for growth, we are in growth mode. We are looking to open 29 shops in 2029. So that's a pretty rapid timeline for our expansion. We're just over 1,000 shops today. So in the next couple of years, you can expect a lot of growth out of us. We're going into new communities, we're opening up in new states, and we're incredibly pleased with the receptions that we're seeing. And in some cases, some pretty long lines to have that first taste of Dutch Bros.
Yeah, certainly Georgia, a big open as of late. I know I keep telling you this, but I'm super excited eventually for you guys to get to the Northeast. And so are some of the sources I speak to. And they say that this Northeast consumer is a bit more health conscious. Maybe they won't be going for more of the sugary options. Are you approaching markets differently? And how are you thinking about that Northeast expansion plan?
Yeah, the way we think about it is we actually approach every customer differently. So we are every drink that we serve can be customized to whatever way you want. We have one of the largest offerings of sugar-free syrups in the market. I've got my protein milk latte this morning, which is what I usually start my day with. And so I actually think we're really well positioned to meet customers where they are, to meet whatever needs they have, given how awesome our Broistas are at really customizing every beverage for our customers.
And one of your competitors recently launched a protein cold foam. You guys were early in on the game of the protein milk. How are you thinking about that? What's the response been over the past year? And now that another player's in the game too, how are you thinking about maybe expanding that platform?
Yeah, so we launched protein in January of 2024, so quite some time ago. And we have a protein-based milk. So our founders were actually dairy farmers, and we worked with all of our dairy suppliers to work on a protein-enhanced milk. And so really you can add it to any drink. And so again, back to that customization theme. This morning I've got an iced protein milk latte with a splash of our chocolate milk on top, which is just delicious.
Absolutely. When you think about this expansion, we are seeing rising competition, including here in the U.S. We have a Luckin and a Starbucks opening next to each other. We also know that Yum Brands, Taco Bell is launching Live Más Cafe. McDonald's is even testing out their cosmic beverages. How are you thinking about the competition right now, and what gives Dutch Bros an edge here?
Yeah, so I think a couple of things. I think one to keep in mind is we've been around since 1992. We grew up in the Pacific Northwest, so we are certainly no stranger to lots of competition. I think the beverage market is large and growing, so there'll always be new competitors coming into the market. I think what's important is having that really strong point of view. So if you look at what we do, we are all about speed, quality, and service. So speed, we are a drive-through concept that allows us to get our customers on their way to their day very quickly. Quality, we are built for customization. The number of different combos you can add to your coffee-based beverage or your energy-based beverage, it's just countless. And we really have that ability to customize. And finally, service, which we believe is just our huge towering strength in that competitive mode. Our Broistas do just an incredible job of talking to our customers, reading where they are, and making their day a little bit brighter as you go through our drive-through.
Christine, as you think about 2026, another crux that you're adding into the mix here is food. That's one of the levers that Wall Street's really looking forward to. And what people may not know is that your bread and butter is food. You were CEO of True Food Kitchen, and you even have a background working for food at Starbucks. How are you thinking about food as a lever in 2026? And what are you seeing so far in the pilot that's working?
Yeah, so we're in 64 shops now with food, and really excited by what we're seeing on early days. I think if you take a step back and look at how customers are making their choices in the morning, it's actually quite important to have a protein-based option. So we talk to our customers a lot. They shared, we absolutely love your coffee, we love your energy drinks, but we really love for you to have a couple of breakfast sandwiches or something that I can grab in the morning as I come through that drive-through. And so in listening to our customers and looking at that market, the morning day part is just really strong. And what we are seeing so far as we've launched food is exactly that. We're seeing great strength in that morning day part as customers come through. We're seeing a love of the food items that we've chosen from both our Broistas and from our customers. And we've kept it really, really simple. Today in all of our shops, we have about 4 food items, and this is just expanding it to 8. So it's a small number of food items, but I think really hits on all those need states and what our customers are asking us to deliver.
Christine, one thing that's different is that your customer seems to be willing to spend. That's different from what we heard from other food executives calling this a very uncertain economic environment that's impacting consumer behavior. How would you describe your consumer right now?
Yeah, so what I would share is I think that we had a very strong quarter, obviously, 6.1% same shop sales, driven by that 3.7% increase in customer transactions. So really pleased with what we're seeing from our customers and from how they're responding to what we're doing. And I think there's a couple of things. I think one, we're in a great place from a value proposition standpoint. I think the size of our drinks, the prices of our drinks, customers are feeling really good about what they're getting from Dutch Bros. And then I think you add on top of that we have a number of idiosyncratic drivers of the business right now that have been successful for others, but we're just getting started on. One example of that is mobile order and pay. So we launched mobile and order and pay in Q4 of 2024. And so we are not even a full year into our launch of mobile order and pay. We're at 11.5% of transactions. So I think there's things like that, things like the food program that can really drive the business forward, even in a difficult environment.
Chrissy, I'm certainly looking forward to hearing more about that mobile order, especially as we make way into this next year. Also food, I'm looking out to try more as well. For Christine Barone, Dutch Bros CEO, thanks so much for taking the time.
Thank you, Brooke.
Julie, back to you.
Brooke, Christine, thank you so much. Appreciate it. The July Consumer Price Index showing prices for food at home rose 2.2% from a year earlier. Joining me now, Stu Leonard Jr., Stu Leonard CEO and president. He's joining us from their store there in Norwalk, Connecticut. Stu, it's good to see you. When we talked, I guess it was early July, you were talking about that you were not really seeing a big tariff effect because a lot of the food we consume is produced here in the U.S. Have you seen that change at all?
Well, right now, the whole tariff thing is quiet. Everybody's really not reacting too much in the food industry right now because nobody knows what's going to happen with the tariffs. A lot of people brought inventory in pre-tariffs, so we're eating through some of those inventory, whether they're lobster tails or any of the other products that we could buy in bulk, tequila, a lot of wines out of Europe, a lot of that stateside. So they're starting to burn through that inventory right now. The tariffs are all kicking in at a new level right now, so the retailers don't know what to do. We're in a pause mode right now. We haven't raised prices. I haven't passed on any tariff prices, even though one thing you can't buy in the United States are things like bananas, mangoes, and some tropical fruit. So our importers are eating it right now. They're not going to do that forever. So I think next month is going to be a key month to determine what the pricing is going to be like going into November, December, which is the huge event for the food industry.
Yeah, I don't know. Maybe eventually with climate change, we can grow some of those bananas in the U.S. after all. We'll see, Stu. But I do want to ask you about aluminum, because there we have seen a tariff. And I know you guys made some changes to your supply chain based on that. Can you talk to me about that?
Yeah, sure. I mean, this is just one of the aluminum pans. Everybody watching is used to seeing these at a food store. And the price of this used to be 11 cents. Okay, with the new China tariffs, this aluminum container went up to 15 cents. Okay, so our buyer, went around and found a company out in Minneapolis. I think it's Handy Foil something. And it's a family business. It's been there 80 years. And they said they would do it for 13 cents each. It's not 15, but it's 13. And they said once they can ramp up and get more volume in the U.S., they said their business is on fire right now. They might be able to get that down to 11 cents for us in the future.
Stu, what would change the calculus and lead you to start to raise prices, right? At what point, is it if you see consumers pulling back a little bit? What kind of goes into that decision-making process?
Okay, well, here's a decision that we have right now. We just got a 50% tariff, from India. They sell a lot of shrimp. Ecuador is 15%. They sell a lot of shrimp also. So one of the things is this looks like it probably, with the tariffs and everything, could be going up 50 cents to $1 a pound. Now, we sell 500,000 pounds of shrimp a year. That's $500,000. I can't absorb all of that extra cost right there. So I'm working with our suppliers, trying to get them to split it with me. And I'll probably, if the tariff thing doesn't subside a little bit this coming month, the retailers have no choice. I mean, we're stuck a little bit. We would have to nudge prices up as little as possible, but we can't. We'd have to absorb some of it.
Okay, there are two more products I want to ask you about where we have seen price pressures. One of them, I don't know if you just heard the interview we did with the Dutch Bros CEO, but coffee. Yeah. We've seen those coffee prices go up. So what then happens to the beans that I'm buying in the store?
Well, what's interesting? You got to look at the tariff thing as one reason costs could go up. The other thing is supply and demand. Coffee is more of a supply and demand issue right now because they've had a lot of drought. The crop's very low down in Colombia right now. And so it spiked coffee prices up. I think the CEO you spoke to from Dutch Brothers, they locked in their coffee prices all year. Most people didn't do that. That was smart of them to do that. But, we've had to bump up our coffee price right now because it's going through the roof. It's like eggs. It's the same thing happening. So we've seen this over the years. It's nothing that has to do with tariffs or anything. It has to do with supply and demand.
Okay, so there is another one that does have to do with tariffs, and that's wine and spirits that are being imported, particularly from the EU. You're the best in the business at show and tell, Stu. I got to tell you. So you are ready. You are ready, man. So is that stuff exempted for now? And if it is that an indefinite exemption?
Well, it's not exempted right now. So we are getting a 15% increase. My daughter Blake here runs the business, and things that are tricky are things like this, which is tequila. You can't buy that anywhere else in the world except Mexico. So right now we're not getting tariff for it, but that could go up. Champagne, what I'm hoping, is that instead of paying a 15% tariff in France for champagne in the region, that people will go to sparkling wine that we produce beautifully in California. Many of the families from France came over and opened up their own vineyards in Napa Valley, Sonoma Valley. So I'm hoping we'll see more sparkling wine this year because it's non-tariff.
And then I'm also curious, Stu, we've seen beef prices go up. People migrate to chicken. Have you been seeing that in the stores as well?
Yes, definitely. I just talked to our buyer. Hey, you want the best prop of all here that we could do, Julie? Look at this.
Of course. I'm not going to say no to that.
Okay. But this is a ribeye steak here. Now, what we've noticed with our customers is they're not sacrificing quality. They are more conscious about price. Customer counts been brisk right here. We notice everybody's a little more hesitant about throwing that one extra thing in their basket. But people are switching right now. Meat prices are at a historic herd size. It's the lowest it's ever been in like 50 or 60 years. There's a lot of droughts out west. It's expensive to feed these animals. So a lot of our ranchers have decided not to invest in new cattle. So there's a low herd size, but people still want a great steak. So it's putting pressure on beef prices. Then again, you might see like 50 cents, maybe $1 a pound on some of your nice center cut steaks, porterhouse, ribeyes, and New York strips and things like that.
Yeah, well, that feels like a special occasion thing anyway. So maybe people are willing to pay up a little bit for it. Stu?
Hey, if you love meat, Julie, it's not special occasion. They eat a lot. Hey, you know what? One little plug here.
Yes, I heard about this. Tell us.
What do you think? I'm going to throw the opening pitch out at Yankee Stadium tonight at 7:00. And I've actually been practicing. I'm throwing the ball when I was waiting to come on here.
Oh, yeah?
I'm trying to hit that organic herb display down there, which is 55 feet. Okay?
I hope the store's not too crowded, Stu.
Hey, hold on. Yeah, I know. I gotta watch. Hold on. Let's see how I do.
All right, let's see how you do. Go ahead.
From Willie Randolph and everybody. Here we go.
Up.
What do you think?
You're ready. You're ready. You're ready, Stu. You're ready.
Hey,
I love it.
I gotta go buy a new herb thing because I just smashed the base.
All right, Stu Leonard, always a pleasure. Thanks a lot.
Hey, thank you, Jill.
Take care of yourself.
Thanks.
Coming up, well, we're talking about coffee even more. We're going to get a check on shares of Starbucks after an analyst upgrade. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke DePalma. We are live at the NASDAQ. Let's get a quick check of all the market action. We're about 2 hours into the trading session, and unlike yesterday, all three major indices in the green this morning. Taking a closer look at the YF Interactive, what exactly we're seeing here is the Dow really leading the gains here. We're seeing that up about 1%, followed by the NASDAQ and the S&P 500, largely after the CPI print came in as expected, and that is signaling the Fed to cut rates come September, with more than a 94% of markets pricing that in. If you take a closer look at the NASDAQ, stocks that are leading the way here in the green, we do have at the top Micron or Microchip moving the most, up about 8%. We also have On running. That stock up nearly 8% as well after the company raised its guidance and beat on expectations on revenue after it was able to offset and navigate tariffs successfully. Moving into the Dow, what's moving there, if you take a look at equal weight, we're also seeing some momentum on Goldman Sachs after a bit of a headline there. United Healthcare also moving higher. Bank of America and Caterpillar also up about 2%. Nike also moving higher, and Home Depot set to report out next week. Disney, which also reported earnings last week, that company stock moving higher as well. If you take a look at sectors, we are seeing a bit of a risk on as investors turn to communications as well as consumer discretionary a bit there, and largely what we're seeing is also this move into tech as they really sort of weigh this once again, this notion, this idea that the Federal Reserve will cut interest rates come September now that we got this data from the CPI print and also that weaker than expected jobs data revision for both May and June. Once again, all three major indices in the green as we make our way into today's trading session. But keep it right here in Yahoo Finance. We'll be tracking all the market moves throughout today's trading session.
Now time for some of today's trending tickers. We are watching Big Bear AI, C, and Starbucks. First up, Big Bear AI shares sinking today. The AI software company reporting revenue for the second quarter that missed the average analyst estimate. The company also lowered its revenue guidance and withdrew its adjusted EBITDA outlook on government contract uncertainty. Still with us, our own Brooke DePalma, and those shares down 26%. This sort of echoes the C3 AI drop that we saw yesterday. So it's kind of interesting here to see, to see some of the smaller AI players face some uncertainty.
Yeah, what we're really seeing play out here is that there are key winners in this environment and key losers. So to say, especially as so many investors have really banked on all AI companies benefiting from this AI boom, this revolution, this environment that we're in, but we're seeing that not be the case. Especially, we saw perhaps, Google, that company jump on their raising their spending forecast. We also saw Microsoft also raise its outlook around AI. And now hearing a company saying, actually, we're not going to raise our outlook. Actually, we're taking a bit of a hit here because of those contracts that have not gone underway. That is certainly raising eyebrows for investors here. And that's why we're seeing a bit of a sell-off. They are much lower than their 52-week high, which was above $10. And Cantor Fitzgerald saying in a report that secular tailwinds and improved financial flexibility is what the report largely reflects, despite near-term execution issues. And of course, just to reiterate that revenue miss was largely driven by the federal program disruptions related to the U.S. Army's efforts to consolidate its data architecture. And so winners and clear losers in this AI boom here.
Yeah, definitely. And next up, let's talk about C, the South Asian e-commerce giant, out with earnings as well. Second quarter sales beating analyst estimates as more of Southeast Asia's consumers turn to online shopping for everything from iPhones to daily groceries. And the results are easing some concerns about the prospects of the e-commerce phenomenon that we're seeing here. Those shares are up by 21%, Brooke.
Yeah, and this company's had quite the run. Over the year, the company's stock is up more than 170%. And just year to date, as this has gone underway, the company's stock is up more than 60%. It's worth noting, too, that if we take a look at the Yahoo Finance platform and we go down to the statistics part of it, if you look at their 52-week high, they're currently trading around 176. So this would be a year high for the stock as well. And this actually reminded me of a conversation that I recently had with the Anheuser-Busch CEO. We did see their Chinese market under a bit of pressure. And what the CEO actually told me is super interesting and goes along with this trend is that the consumer in China is staying more at home, that Anheuser-Busch actually caters to restaurants and bars there, and they now need to adopt and learn and lean in to this consumer that's more digitally native. And we also saw a company like Luckin Coffee do well there as they're very digital focused. This customer also leans into heavily in food apps and delivery. And so certainly we're seeing this company that plays into the e-commerce market with a very digital native consumer win big here and see key returns.
And finally, squarely in your wheelhouse, Starbucks is getting upgraded at Baird to outperform from neutral. The analyst there says that he has high conviction that turnaround strategies under new leadership will be effective in transforming Starbucks into a better company. You know a lot about this, Brooke, having spoken to the company, having covered the company in detail, because there has been sort of this, uncertainty about how effective all of these efforts were going to be.
Yeah, we're certainly continuing to see a sales slump when it comes to the U.S. same-store sales growth for Starbucks. Once again, seeing a sales slump still happening here, but there's been some change in optimism about what exactly CEO Brian Niccol will bring to the table here as he really doubles down on something we just heard Dutch Bros weigh in on, and that's speed and efficiency and quality, and also that value perception. That's something that Brian Niccol believes that it needs to lean more into. And fun fact here is that tomorrow actually marks 1 year since Brian Niccol was named the CEO of Starbucks. And so it's interesting timing that we're getting this upgrade from an analyst here who really is betting on the fact that this will be a better company after it makes all these changes. But I think that the story is still yet to unfold. Of course, a new CFO just joined as well. And so we don't know exactly the guidance for the full year. They do expect the second half to be stronger, but ultimately remains remains to be seen. The optimism, though, on the street right now, there are 19 buys on the stock, 16 holds, and 1 sell. And so there's a bit of bullishness around Starbucks heading into the second half of the year.
Yes, there is. All right. Thanks so much, Brooke. You can scan the QR code below to track the best and worst performing stocks with the Yahoo Finance's trending tickers page. We also have some breaking news here. Artificial intelligence startup Perplexity offered to buy Google's Chrome browser for $34.5 billion. That is according to the Wall Street Journal. Now, as we know, there is a court case going through whereby Google might be forced to sell Chrome. And so now Perplexity stepping in here, according to the Journal, and making this offer. Interestingly enough, whereas it's making this offer reportedly for $34.5 billion, Perplexity's own valuation is reportedly only $18 billion. But according to the Journal, Perplexity has gotten backing from some large venture capital funds that then would allow it to make this size of a transaction. Now, if the judge is going to force Google to sell off Chrome, having an offer outstanding, would it make it more likely that the judge can come out and do that? That is sort of the question here. Google itself has not really said that it wants to sell Chrome, right? It has maintained that it wants to keep these businesses together, that they do work together well here. Perplexity, one of the startups within the generative AI business that has really gained some market share, and it actually recently released its own web browser to some of its users here. So we'll continue to watch the situation. If you look at those Alphabet shares, they're actually not moving much in reaction to these headlines. And it doesn't seem that it is the base case of many analysts we've spoken to that Alphabet will be forced to break up. So we'll see what this latest development means for that whole situation. Coming up next, what does the Trump administration's plan to sell more shares of Fannie Mae and Freddie Mac mean for you and your money? We'll take a look next.
President Trump is moving closer to taking Fannie Mae and Freddie Mac public, an IPO that could raise about $30 billion for taxpayers and start unwinding their 2008 conservatorship. And in this Stocks in Translation episode, we're going to explain who they are, why this matters for your mortgage, and what an IPO would and would not change. Both Fannie and Freddie, they are GSEs, that's government-sponsored enterprises, which are private companies that are chartered by Congress to keep credit flowing in a key market like housing. Fannie Mae was born all the way back in 1938 to keep mortgage money flowing after the Great Depression, and Freddie Mac, it arrived on the scene in 1970 to boost competition and liquidity in the market for mortgage trading. Together, these two giants have touched about half of all outstanding mortgage debt in the U.S., which keeps the lending pipeline open. And after these mortgages are bundled together, Fannie and Freddie help anchor the prices of those bonds. They also help make 30-year fixed loans possible by buying loans and guaranteeing mortgage bonds, which lowers costs for lenders. Thanks to them, U.S. mortgage holders save about 10 basis points on their rates on average. Not huge, but the savings compound and they grow over decades. Now, here's a timeline that starts with the global financial crisis. In 2008, Fannie and Freddie were put into conservatorship, into the care of the U.S. government. In 2010, they left the New York Stock Exchange, but continued to trade in the less liquid over-the-counter market, or OTC. That's why we have stock prices for the last decade. From 2012 on, most profits were swept into the U.S. Treasury to the tune of $300 billion by 2019. These actions ignited a decade of lawsuits. Then from 2019 to 21, policy shifted a bit to let them keep earnings and also rebuild their capital as a buffer. Now here is a chart of Fannie Mae since the late 1980s, and notice the huge run-up into the middle of the chart around the global financial crisis. Also notice the big drop. Freddie Mac's chart looks almost identical. Neither stock did much for a decade, but some titans of Wall Street, they did amass big stakes, like Bill Ackman's Pershing Square hedge fund, and also John Paulson, who famously bet against housing over the GFC. You can see this stock has recently come to life right here, but the prices have been swinging mainly on policy headlines and court rulings, not on traditional fundamentals. Bank expert Chris Whalen of Whalen Global Advisors recently appeared on Yahoo Finance and hammered home some key points. Let's take a listen.
First and foremost, the government has to get paid. So what it's going to mean is that the existing shareholders are going to be massively diluted. The federal government will probably end up owning over 90%. They will always be backed by the Treasury. That's the reality.
If the IPO goes forward, these two mortgage giants could be worth over $500 billion combined. So it's important to spell out what the IPO would do and what it would not. An IPO means new shares, new capital, and likely a major exchange listing. But as Waylon just said, the government backstop will likely continue unless Congress rewrites the law. That's actually good for mortgage rates. And in case the giants are restructured or wound down, the Treasury gets $355 billion before anyone else. And all the dividends already paid, they do not reduce that tab. If you're shopping for a new mortgage, the IPOs are not going to affect you too much unless there's a big unexpected change. And for stock investors, it's a bet on the health of the U.S. mortgage market, but subject to huge event risk. The big movers are going to come off headlines in the press and also from the courts. At the end of the day, this story is about capital, terms, and your mortgage cost, in that order. If the plan is clean and credible, the housing pipeline stays stable and investors, they get clarity. If it's messy or delayed, expect volatility in the stocks and more volatility in mortgage rates in general. Tune in to the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts. More market catalysts after this.
Circle shares are rising after topping Wall Street's estimates for its second quarter revenue. The stablecoin issuer is seeing an 86% growth rate in the circulation of its USDC coin. It also announced a new blockchain network for stablecoin finance that's set to launch in the second half of the year. This is, of course, the first report for Circle since it went public a couple of months ago. The stock is up 400% from its IPO price of $31 per share. Joining me now on this is Jeremy Allaire, Circle co-founder and CEO. Jeremy, thanks for being here.
Thank you. It's really a pleasure to be here.
Yes, I'm sure on such a day as well when you're reporting these kinds of numbers. So you guys have seen huge increases in issuance, in circulation, in transactions using USDC. Can you tell me a little bit about what has driven this? How is it being used and who is using it?
Yeah, I mean, we really, really over a year ago have seen this kind of very, very steady rise in supply of USDC. We've grown faster than any other major stablecoin, as you noted, 90% year on year, and year to date, sitting on August 10th, over 65 billion in circulation, which is about 49% year to date growth. So we're seeing that strong growth, and we've seen that growth actually accelerate in even the most recent weeks. And I think there are a number of things happening. I think one is just overall activity globally in the digital asset economy has been growing. I think a second, and we've talked about this a lot, is we're continuing to see growth in the use of dollar digital currencies like USDC as a store of value around the world in cross-border settlements, whether that's between people or businesses in emerging markets. And we're seeing more and more use cases in traditional payments networks and in capital markets use cases. So use cases continue to expand. And I think people are finding that this is an incredibly high utility new form of money, which, as you know, also this quarter was solidified by really being enshrined in federal law through the passage of the Genius Act. And so I think a lot of these things are contributing to the interest and the demand. And then obviously on a go-forward basis, the number of mainstream financial institutions, technology companies, large corporations that want to use this infrastructure is really growing, and we're seeing that demand coming in.
So it sounds like the shorter answer is everywhere and from everyone in some ways, Jeremy. I am curious if you can tell me more about those cross-border transactions, how it's being used in emerging markets. Do you have an idea of sort of the percentage of transactions that are being done overseas versus in the U.S., for example?
Well, we believe, and we have very good data, that a material majority of transactions are non-U.S. There's actually a lot of activity out of Europe, but there's also significant activity in emerging and developing markets ranging from Latin America to Africa to Middle East to Southeast Asia, and sort of the Asia market as a whole is a significant one. And while we don't sort of see every transaction in terms of the counterparties, what we do see are sort of trends in flows. And so you're seeing flows that are through really powerful corridors, whether it's Latin America to Asia, suppliers and buyers, Middle East and Africa, which again is common kind of corridors in economic activity. So we see that, and it's one of the reasons why we built Circle Payments Network and launched CPN in Q2, is building a sort of application layer that financial institutions can use to more efficiently do international money movement and cross-border settlements using stablecoins as the settlement mechanism. And we went live with 4 corridors during the quarter: Hong Kong, Nigeria, Brazil, and Mexico. And through the remainder of the year, we're going to keep adding more and more corridors that allow financial institutions to take advantage of the speed, the efficiency, and the programmability of moving money on these networks.
Jeremy, you've offered these new services. You're collecting some fee income from some of them, but the vast majority of your revenue still comes from gathering interest on stablecoin reserves. What happens if and when the Fed cuts interest rates, whether it happens in September or beyond that? Does that then cut down on your revenue, on your interest revenue?
Yeah, I think there's a few key things to think about here. The first is that as expectations of rate declines came, and then as actual rates declined over the last year, we've seen significant growth in USDC. And so we've observed historically a kind of inverse correlation there. And so that 90% year-over-year growth is very significant and has actually contributed, even though you've seen a decline in the rate environment, it's actually contributed to an increase in revenues. And in fact, we saw our adjusted EBITDA grow 52% year on year with an adjusted EBITDA margin of 50%. So there are multiple dynamics at play. And in fact, we believe that lower interest rates are going to be accelerative to the business as money velocity picks up, as invested capital picks up, and as more people are putting money to use in the economy. This very high utility form of money will grow, which leads to the second point, which is there are a lot of perspectives on just the technology utility of this driving growth. And there are estimates ranging from the Treasury Department saying this will be $2 trillion by 2028 to bank analysts saying this could be $3.5 trillion by 2030. And so the utility and network effects of this technology are also a source of growth. And so what one has to really look at is step back and look at, what kind of growth is going to come from the establishment of these stablecoin networks and the velocity of money on these networks. And then obviously back to your core question, we are building new products and services. We're adding major new features to our existing products and services that allow us to generate new income streams, subscription and services fees, transaction fees, and that collection of revenue actually grew 250% year on year, and we expect to continue to grow that. And so that is also margin uplift. We saw 200 basis points of margin uplift from these new higher margin revenue streams. And so over the long run, we expect to be able to grow the money stock on the network, grow the scale of the network, and grow these other services and revenue streams. And that gives us, a belief that this can be an even more profitable company over the long run on an adjusted EBITDA basis.
And obviously that's what investors think too, judging from the stock price. Jeremy, it's great to see you. Thanks for joining us.
Thank you, Julie.
That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. More Yahoo Finance coming up.